Hi. Let's learn about Leveraged Employee Stock Ownership Plan, LESOP. A leveraged employee stock ownership plan is a form of employee compensation program in which the sponsoring company borrows money to fund the plan and purchase shares from the company's treasury. The shares are then used for the stock ownership plan, with the company subsequently paying back the original loan with annual contributions. Companies use ESOPs or other equity compensation programs to tie a part of their employees' interests to the bottom-line share price performance of the company's stock. This gives participating employees an incentive to ensure the company's operations run as smoothly and profitably as possible. By leveraging company assets, the business can provide for its stock ownership plan and give workers ownership interest in the company without immediately putting up all the capital required to do so. LESOPs serve as a tax-advantaged method of financing corporate growth because shares allocated to an employee's account are not taxed until distributions are received, which generally occurs after an employee ends their tenure with a company. Due to deduction limitations dictated under tax laws, employer contributions to make annual loan payments may not exceed 25% of a participating employee's annual compensation. Despite the tax-deferred benefit participating LESOP employees enjoy, this plan isn't without potential downsides, chief among them, an inherent investment risk. Since a LESOP functions as a substitution for other types of qualified retirement plans, they may lack the diversification of a typical retirement portfolio. Employees who reach the age of 55 and have completed at least 10 years of participation in a LESOP are permitted to diversify 50% of their accounts over 5 years in investments other than their own company's stock. Additionally, since a LESOP involves borrowing, it can affect a company's debt-to-income or debt-to-equity ratio, making it appear as a less attractive investment than it may otherwise be. Moreover, if a company cannot repay its LESOP debts, the lender can seize the assets put up as collateral. Here are 4 key takeaways. 1. A leveraged employee stock ownership plan, LESOP, uses borrowed money to fund an ESOP as a form of equity compensation for employees. 2. The company borrows against its assets and then repays the loan used to fund the ESOP via annual contributions. 3. The benefit of a LESOP is that a company does not need to expend cash upfront to fund the ESOP. 4. However, since it involves taking on a large amount of debt, it must be executed with caution. Hope this would help. Thanks for watching.